Imagine this. You wake up on a Tuesday morning. Your alarm goes off at 7 a.m. You reach over, you grab your phone, and before you've even had a sip of coffee, you're already scrolling through the news. And the first headline you see is, U.S. conducts retaliatory airstrikes against Iran-backed forces in Syria and Iraq. You scroll down. Russia launches its largest ballistic missile barrage on Kiev since the start of the war. You scroll again. Houthi rebels strike another commercial vessel in the Red Sea, disrupting global shipping lanes. One more. Federal Reserve. No rate cuts expected in the near term. You put the phone down for a second, you take a breath, and then, almost by reflex, almost by instinct, you open your brokerage app. Your finger hovers over the screen. You squint. You brace yourself like you're about to take a punch. Because surely, with everything happening out there, the market must be bleeding. Your portfolio must be down 10, 15, maybe 20%. The world is on fire. Logic dictates that markets should be falling. And then the screen loads. The S&P 500 is up 0.6%. Your portfolio is in the green. Nvidia is up 3%. Microsoft hit another all-time high overnight. You sit there, completely dumbfounded, coffee still untouched, trying to reconcile what you just read with what you're now looking at. It makes no sense, or at least it doesn't seem to make sense. And that gap, that cognitive dissonance between the chaos you see in the news and the stubborn resilience you see in your portfolio, that's exactly what we're going to close today. Because here's the truth. The stock market's refusal to collapse is not random. It's not irrational. It's not a bubble waiting to pop at the next headline. There are deep, structural, and very logical reasons why markets keep climbing despite wars, despite geopolitical tension, despite everything. And once you understand those reasons, really understand them, not just on a surface level, you stop reacting to every scary headline and you start making smarter, calmer, more profitable decisions. That's what Max is here for. Let's get into it. Part 1. The market is not the economy, and it's definitely not the news. Let's start with the most important foundation you need to have. The single most expensive misconception that retail investors carry, the one that has cost ordinary people billions of dollars in missed gains and panic-selling losses, is the belief that the stock market is a mirror of current events. That when the world looks bad, the market goes down. And when the world looks good, the market goes up. It sounds intuitive, it sounds logical, and it is almost entirely wrong. The stock market is not a reflection of today. It is a prediction machine. It is a massive, decentralized, collective forecasting mechanism that is constantly, every single second, trying to price in what the world will look like, not now, but 6 months, 12 months, and sometimes several years from now. Every trade that happens on that exchange is someone making a bet about the future, not the present. The future. This matters enormously when you're trying to understand why markets don't react the way headlines suggest they should. When you buy a share of a company, you are not buying what that company is worth today. You are buying a discounted estimate of every dollar of profit that company is expected to generate for the rest of its existence. You're buying the future packaged into a share price. And so, when institutional investors, the people moving hundreds of millions, sometimes billions of dollars, when they look at a geopolitical event, the question they ask is brutally simple. Does this materially change the long-term earnings outlook of the companies in my portfolio? That's it. That's the question. Not, is this tragic? Not, is this dangerous? Not, does this make me feel scared? Just, does this change the earnings trajectory? And in the vast majority of geopolitical events, as cold and clinical as this sounds, the honest answer is, not really. Not for the dominant companies in the modern US stock market, not in any sustained, structural way. Understanding this one principle will save you from making panic-driven decisions more times than you can count. The news is not the market. The economic consequence of the news is the market. And those two things are often very, very different. Part 2. The Middle East. Why the market isn't panicking. Let's get specific, because the Middle East is the region that has the most investors worried, and rightfully so on a human level. We're talking about an active conflict involving Israel, Iran-backed proxy groups, Hezbollah in Lebanon, the Houthis in Yemen firing missiles and attacking commercial ships in the Red Sea, and the constant threat of a broader regional escalation that could pull in major world powers. On paper, this looks like the perfect recipe for a financial catastrophe. So why hasn't it been one? The answer starts with oil. Every time the Middle East flares up, the first thing sophisticated investors do is run a scenario analysis on oil supply disruption. Because oil is the transmission belt, it's how a regional military conflict becomes a global economic crisis. The last time the Middle East truly broke markets was during the 1973 oil embargo, when Arab oil producers cut off supply to the United States and prices quadrupled almost overnight. That triggered a stock market crash, a recession, and years of economic pain. But here's what's fundamentally different in 2025 compared to 1973 or even 1990. The United States is now the world's largest oil producer. Full stop. American shale production has completely transformed the global energy landscape. The U.S. produces more oil than Saudi Arabia, more than Russia. The dependence on Middle Eastern oil that made those 1970s crises so devastating simply does not exist in the same form anymore. Yes, the Houthi attacks on Red Sea shipping have driven up shipping costs. Yes, companies have had to reroute cargo around the Cape of Good Hope, adding weeks to transit times and millions in extra costs. Yes, oil prices have been volatile, but the critical threshold, the one that would actually break markets, is a closure of the Strait of Hormuz, the narrow waterway through which roughly 20% of the world's oil supply flows. That has not happened. Every escalation has stopped short of that line. And as long as global oil flows remain fundamentally intact, the economic damage from Middle Eastern conflict remains manageable and containable for the broader stock market. There's a second layer here that most people completely overlook. The composition of the stock market has changed dramatically over the past 30 years. The S&P 500 today is dominated by technology, healthcare, software, and financial services companies. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta. These companies generate the vast majority of their revenues from digital products and services, from cloud subscriptions and software licenses and advertising and semiconductor chips. A war in the Levant does not reduce demand for cloud computing. A Houthi missile strike in the Red Sea does not make businesses stop buying Microsoft 365. The structure of the modern economy is fundamentally less exposed to traditional geopolitical disruptions than it was 50 years ago. The market knows this, and it prices accordingly. Part 3. Ukraine. 3 years in and what markets have learned. Let's talk about Ukraine. Because if there was ever a war that should have broken global financial markets, many analysts thought it would be this one. February 2022. Russia launches a full-scale invasion of Ukraine, the largest land war in Europe since World War II. A nuclear-armed power invading a sovereign nation on the European continent, millions of refugees, a European energy crisis, massive sanctions, and economic warfare. If you had told anyone in January 2022 that all of this was about to happen, they would have told you markets would crater. And yes, markets did sell off sharply in 2022. The S&P 500 fell roughly 20% from peak to trough that year. But here's the critical thing people get wrong about that sell-off. It was not primarily caused by the war itself. It was caused by the economic consequences of the war, specifically the explosion in commodity and energy prices that fed into already elevated inflation, which forced the Federal Reserve to raise interest rates at the fastest pace in 4 decades, which compressed the valuation multiples across every asset class. The market wasn't reacting to the geopolitical event, it was reacting to the interest rate implications. And once the Fed signaled it was getting inflation under control, the the market began recovering, even while the war continued unabated. That is an extraordinarily important distinction. Now we're 3 years in, 3 years of war. And what has happened? Europe adapted. The feared collapse of the European economy due to Russian energy cutoffs never materialized at the catastrophic scale that was predicted. Germany found alternative gas suppliers. Renewables were accelerated. Industrial demand adjusted. The European system, while damaged, held together. Moreover, markets have fully internalized the Ukraine war as a known ongoing condition. And this is crucial to understand. Markets do not just hate bad news. What markets truly cannot stand is uncertainty. Unknown bad news is far more dangerous to financial markets than known bad news. In the first weeks of the Ukraine war, nobody knew how far Russia would go, whether NATO would be drawn in, whether nuclear weapons would be used. That genuine uncertainty created panic. 3 years later, the situation, as terrible as it is, has been reduced to a grim, semi-stable status quo, a frozen conflict zone, and markets have moved on to pricing the future beyond it. Part 4. The liquidity trap. Where does the money go? Here's a question that doesn't get asked nearly enough. If not the stock market, then where? This is one of the most structurally important reasons the market has remained resilient, and it almost never gets discussed in mainstream financial media because it sounds too cynical, but it's completely real. There is an almost incomprehensible amount of institutional capital, pension funds, sovereign wealth funds, insurance companies, university endowments, family offices, that has legally mandated investment requirements. These entities collectively manage somewhere between $100 and $200 trillion globally, and they cannot simply exit markets and go sit in cash. They have obligations. They have target returns. They have allocation frameworks that require them to hold significant percentages of their portfolios in equities at all times. So when you wonder why the market doesn't collapse even when the news looks terrible, part of the answer is simply mechanical. There are enormous pools of money that have to be invested somewhere, and equities remain the most compelling option available at scale. Bonds just came off one of their worst decades in history. Real estate is illiquid and regionally inconsistent. Commodities are too volatile for most institutional mandates. Cash gets eaten alive by inflation over any meaningful time horizon. Crypto is still not accessible or appropriate at institutional scale in most cases. Equities, particularly high-quality, large-cap, cash flow-generating equities, remain the default. And that default status creates a constant gravitational pull of capital toward the stock market that acts as a persistent floor under prices. Add to that the transformation in retail investor behavior. The COVID crash of March 2020 lasted 33 trading days, 33 days from peak to trough and back again. Anyone who bought during that crash, anyone who held their nerve, made extraordinary returns. That event hardwired an entire generation of new investors with a reflex. Crashes are not catastrophes. They are opportunities. Every scary headline since then has been met not with mass panic selling, but with a significant segment of the retail market asking, "Is this my entry point?" That dip buying reflex, operating at scale, creates buying pressure precisely at the moments when selling pressure is highest. It dampens volatility. It creates floors. And it is a structural feature of today's market that simply did not exist 20 years ago. Part 5. The AI revolution, the force that changes everything. If you take everything we've discussed so far, energy independence, adapted market structure, institutional capital flows, retail investor behavior, and you add them all together, you still might be left wondering, but what's actually driving the market higher? What's the positive force, not just the absence of collapse? The answer, more than anything else, is artificial intelligence. Max wants to be very direct with you here, because this is a point where a lot of people get tripped up. They hear AI and they immediately think bubble. They think hype cycle. They think tulips and dot-com mania. And that skepticism, while understandable given history, is wrong in this case. Or at least it's premature. Because the revenues are real. The adoption is real. The infrastructure spending is real. This is not speculative future revenue being priced in without any basis. It is actual, audited, reported revenue growing at rates that are genuinely extraordinary. NVIDIA's data center revenue, driven almost entirely by AI infrastructure demand, grew from roughly $4 billion per year to well over $100 billion annually in just a few years. Microsoft's Azure cloud platform is growing rapidly, driven by AI integration. Google's search and cloud business is being transformed by AI. Meta rebuilt its entire advertising business around AI-driven targeting and saw its profits nearly triple. Amazon's AWS continues to dominate cloud infrastructure. These are not projections, these are income statements, and crucially, the capital expenditure wave is only accelerating. Microsoft, Google, Meta, and Amazon have each committed to hundreds of billions of dollars in AI infrastructure investment over the coming years. That spending doesn't disappear into a void. It flows into NVIDIA's revenue. It flows into construction companies building data centers. It flows into energy companies providing the electricity. It flows through the entire economy, generating earnings across multiple sectors. This is a genuine technological transformation on the scale of electrification or the internet. And when you are in the early innings of a transformation that significant, markets have historically looked through enormous amounts of geopolitical noise to price in the long-term opportunity. Investors in the early days of the internet didn't let the Balkan Wars or the Asian financial crisis or the Russian debt default push them out of their technology positions. The ones who held through the chaos captured generational wealth. The ones who let the headlines drive them out missed it entirely. Part 6. What could actually break everything? Intellectual honesty matters. Max is not here to tell you everything is fine and nothing can go wrong. That would be irresponsible. The market can fall. It can fall hard and fast. And you deserve to know what the genuine risks are. Not the theatrical risks that generate clicks, but the real structural catalysts that could actually cause a sustained, serious market breakdown. The first genuine risk is a full-scale closure of the Strait of Hormuz, if direct. US-Iran military confrontation escalated to the point where that waterway was physically blocked for weeks or months. Oil prices could reach levels that would reignite global inflation in a violent, uncontrollable way. Central banks would have no good options. Recession risk would become severe. That is a genuine tail risk, and it is the geopolitical scenario that deserves the most attention. The second real risk is a credit event. Somewhere in the global financial system, there are leveraged positions and hidden exposures that are functioning normally under current conditions, but could unravel catastrophically if conditions shift suddenly. This is how 2008 happened. Not from a war, not from a geopolitical event, from a hidden accumulation of leverage in the housing market that nobody could see clearly until it was unraveling. The same potential exists today in private credit markets, commercial real estate, and certain corners of derivatives markets. The third risk is an earnings disappointment. The market's current valuations are pricing in continued strong growth, particularly in technology and AI. If AI capital expenditure fails to translate into the productivity gains and revenue growth that are being projected, if corporate earnings start missing estimates consistently, the multiple compression could be swift and brutal. High valuations require high growth. Remove the growth, and valuations fall to find a new equilibrium. The fourth is great power conflict escalation. A direct military confrontation between NATO and Russia, or between the United States and China over Taiwan, would represent a paradigm shift that no financial model is equipped to price. Markets are currently assigning a very low probability to these scenarios. If those probabilities rose sharply, the repricing across all risk assets would be severe. These risks are real. They deserve to be monitored. But until they materialize in a serious, sustained way, they remain tail. Scenarios: low probability, high impact. not base cases. The close. What smart investors do with this knowledge? Let's bring everything together. Why has the stock market refused to collapse despite wars in Ukraine, escalating tensions across the Middle East, high interest rates, political uncertainty, and seemingly endless bad news? Because the market looks forward, not backward. Because American energy independence has fundamentally changed the vulnerability equation. Because 3 years of war in Ukraine has been fully priced in as a known variable. Because institutional capital has no better alternative than equities at scale. Because a generation of retail investors has been trained to buy volatility, not flee from it. And because artificial intelligence represents a genuine revenue-generating, economy-transforming technological revolution that is creating real earnings growth across the most important companies in the world, the market is not ignoring the bad news. It has looked at the bad news, run the numbers, and concluded that the earnings trajectory of modern businesses, particularly technology businesses, remains intact. Now, what does this mean for you specifically? It means that every time you feel the urge to panic sell because of a scary geopolitical headline, you need to stop and ask the one question the market is always asking. Does this materially change the long-term earnings trajectory of the companies I own? If the answer is no, and most of the time it will be no, then your rational move is to hold or potentially to buy more. Tell me what video you want me to make next. See you.